How might you go about finding stocks you could hold for the indefinite future? Stocks whose companies are so strong, so profitable, so clear about their business model that barring some fairly dramatic turn of events, you could feel great about owning them for the long haul. Stay tuned as our own Roshan Loungani gives part 2 of his 2-part deep dive for finding such stocks right now on the Retirement Lifestyle Show. Welcome to the Retirement Lifestyle Show. I'm Erik Olson, once again joined by my 2 co-hosts, Adrian Nicholson and Roshan Loungani. We're back with part 2 of a 2-part series on Roshan's approach to doing a deep dive on finding stocks that, at least theoretically, you might be able to hold for the indefinite future. And last week, if you were with us, we talked at length about how Roshan, first of all, identifies various stocks through the broad process of ideation, and then what specific screens that he then puts in place so that he can narrow that from that big universe of possible candidates down to a portfolio set of candidates that's at least sufficiently reduced in number that he actually could have a real shot at actually getting into the weeds with each one of those stocks. And today we now get to learn from Roshan what it is that he does once he's narrowed it down to those final candidates that he really wants to scrutinize closely, how he then gets into the recordings that they do, the documents that they produce, so that he's not just looking at high-level quantitative information about these companies. He's understanding the story of that company and how it lines up with his thesis about what are going to eventually become, if they aren't already, the great companies you could hold for the indefinite future. So Roshan, Adrian and I are really looking forward to this part 2. And of course, you know I love a series more than anybody. So it just makes me happy that we're having a series, even if it was on, let's say, comic books or something just that we have a series going now. I'm really, really happy about that.
Yeah, and if you look at it, it's really a 3-part series because you broke down factor investing, then I broke down the screening last week, and this week we're going down once you've screened for a stock, the deep dive. So we've got a good series here, and I'm sure next week we'll talk about something totally different. Maybe not. Maybe we'll keep the streak going. But let me give a quick...
I want to give Can I just give listeners, are you going to be showing anything today? Because if you're going to be doing that, I want to point our listeners to the YouTube channel.
I'm not, unless there's anything we've got to search and find.
Okay. All right. Well, great. So why don't you tell our listeners why you think this is important? Because I sure do.
So we went over screening last week. I'll go over that criteria again in a moment. But once you've screened to find a company, well, now what? Now what do you look for? And I've had many iterations of what I'd call checklists, but they're really research points, things I want to find and understand. I'm going to share that with you today. A quick recap on last week. What I was looking at for screens, essentially my goal is to manage my time. So because the deep dive research can take a long time. And so I was looking to narrow the list of stocks I want to take a deep dive on. I was looking at companies with a market cap over $1 billion, companies where revenues were growing, companies that were profitable based on their return on capital and return on equity, and or depending on the company. I like inside ownership, so companies where CEO, other levels of management own stock. And then I was viewing from a valuation perspective the price to earnings ratio, the PEG ratio, price earnings growth, the earnings yield, the enterprise value to EBIT and enterprise value to EBITDA. And I was using those, and then I was really sorting with multiple fields. So as I came up with what that did was that narrowed the list of, from thousands and thousands of stocks down to about 40. And then I would sort those various fields to figure out, okay, where do I want to spend my time? Now that I've, in theory, selected a company, I want to go into what I'm looking for. And we'll discuss those categories. And Adrian and Erik, I'd love if you have any thoughts or ideas on things to add or things to expand on, any questions. But the very first thing I want to do is understand the business. So I try to research the company and look at the business model. A lot of that information can be pretty easily found online now. So you go to their website. I look at their annual reports, and I look at their quarterly calls. They've also typically got a lot of presentations online to start understanding the business model. So, gentlemen, any questions so far?
Yeah, I like where we're starting off with this. And to use an analogy, it seems like you're putting a face to a name, so to speak, where you're screening all these companies, looking at their data, their fundamentals, all this information. And once it passes your screen and this looks like something interesting where you can invest in, you dive in a little bit deeper to paint a picture around these numbers just to see if this is something that you can move more forward with. And it's like you said, it's presentations, it's calls, it's just more deeper information where you can get to know your investment in an extra level or an extra layer. So I think that's an analogy that I think you're trying to paint for our listeners and our viewers right now. So I really like where we're headed.
Yeah, completely right. And if you're investing your money in a company, you want to know where it's going, right? So when you look at the business model, you want to know not only what type of business are you investing in and what they're doing with the money, how they're getting those returns. So I think it's very important to understand what does the business do. Some cases this is very simple. When you look at particularly the smaller companies, it's usually a simple business model. They'll provide a product or a service to X customer, and you can figure that out. The bigger the companies, the more subsidiaries you have, the multiple businesses that you have, it can definitely make it more complicated. Um, Now, once I've gotten an idea of the business model, what I'm looking for here is next, and this isn't always a deciding factor, but I want to know what their market share is. Ideally, a lower market share. The reason I say that is because do they have a room to grow and expand? If I've got a company that's got 90% market share that I'm researching, it's not like I'm going to say no, I'm not investing to this company. It's just can they maintain that growth? They've got, if they're dominating the market already, how much room do they have to grow? If they've got a low market share, their business model is a good business, good profitable business model. Well, they've got a lot of room to expand then. Um,
Doesn't the economic environment play a big factor in that? Because, for example, if you're in a really tough economy or market, whatever it may be, it could be very enticing seeing a company have, when we say market share, an example would be just, let's just say there's 10 competitors, and one of the competitors is just really selling all their products and really taking on all the business from the customers. That's a large market share. And in an economy that's not doing well, that's something that you really like and it's very enticing for you to invest in. Where if you're in a really bad market and a company has a very small market share, yes, there's opportunity, room to grow, but there's also more risk that they don't meet that and they don't grow, so to speak. Just something that came to mind when you brought that up.
And a lot of what we're going to go over today is going to be what your opinion is as you're researching this. But yeah, there'll definitely be a situation where the market share is so low and the bigger player so dominant that it might be very brief time researching. You'll get to this point, you'll say, okay, I don't think this is a good fit for what I want to invest in. So yes, that can play a part. On the flip side, if you look at it and in your example of 10 companies, let's say they all have 10% of the market share. So you don't really have a dominant player. Do you think this company you're researching can take market share from the others and become the dominant player? The next thing I'm looking for is it a large and growing market? So to that example of 10 companies that own 10% of the market each, if the market itself is growing by 10% a year, if they maintain market share, they're still growing. They're growing at a faster rate than the U.S. economy is typically growing. So that could help lead to outperformance, and they're not even taking market share from a competitor. Next, where are they investing their cash flow? So are they taking their money and investing it into a highly profitable place that they can continue to invest in? Are they investing it in a dying business that you don't believe in? Are they sending it all back in the form of dividends and stock buybacks? So when you're investing in this company, you're investing in a business, and as I mentioned earlier, you want to know what they're doing with your money, so to speak, right? So where are they putting that money, and do you believe in it, right? If they're putting it in a space where there isn't going to be growth, um, and you don't believe in it, then it's probably not the right thing, right? Or are they investing in something totally different, right? Are you buying a company that's known for like a famous one? I might get the story wrong, but I remember at one point McDonald's was like investing in the shrimp business or something like that. And
Hmm.
you want to invest in McDonald's. This goes back to the 80s, by the way, so it's not necessarily relevant today. But if you're buying them because you like McDonald's and you think McDonald's is growing, but the money they're getting, they're investing in something totally unrelated that they don't necessarily have expertise on, that might be a reason to pass, because you want to invest in McDonald's and its continued growth, but they're taking your money and putting it somewhere else, right? Where it doesn't, they don't necessarily have the expertise, or their existing business doesn't necessarily benefit them. I remember reading years ago about a famous investor that was started investing in McDonald's as soon as they saw that they changed those plans and were just trying to expand McDonald's globally. Another um, example is I believe Coke had their ventures in other spaces as well while they were growing, but they've got their name brand, and then they just said, all right, we're going to acquire other companies in the beverage space and expand, and that's what they've done. They've done a great job of it. The last question on the business itself, this tends to be the toughest one for me. What is their sustainable competitive advantage? Some companies in their annual reports, they'll try to tell you, here's what our competitive advantage is. And it might be right, it might be wrong. It's their opinion of it. You've really got to look to figure out what you think their advantage is. Are they, some of the common ones are they a low cost provider? Do they have some kind of, network effect? Like just thinking of the iPhone, for example, it's pretty tough to get an iPhone person to go to the Android space and vice versa, because they're sort of locked into the apps they like, the network they like, the interface. And then you've got network effects like with like a Meta with Facebook. So many people are on it that a competitor would really have to grow to bring all those people all those people over. Those are just different types of competitive advantages out there. So figuring out what this company's real competitive advantage is, that's a tough one, and that tends to take up a lot of time when you're doing research. So those are the bullet points I start with when analyzing the business itself, and it can lead anywhere. Last week, E- Eric, I think it was you, it may have been Adrian, that asked me how long it takes to research, and I said that I really
Mhm.
don't know. You start and you just don't know how far you're going to get. Like Adrian, that market share question. If it turns out that they had such a low market share and I don't like them, I can probably be done and ready to move on in an hour. On the flip side, I can spend days trying to figure out what's the sustained competitive advantage, and so it can, or longer.
So let me just recap for our listeners, and you verify that in fact we've captured these. So the five things that you're looking at, number one would be what's the business model, and I do have some questions about several of these. So number
Mhm.
one, what's the business model? Number two is what's the market share? You prefer all else being equal, smaller, because that implies that there's room to grow within that industry space. They can capture market share if they're doing things well. Third, is the industry itself growing? If it's a dying industry, even if they're capturing market share, that may be only then very short lived. Conversely, if it's a growing category, even if they're not rapidly expanding their market share, they still could be growing faster than the US economy. Number four, where are they directing their cash flows? Are they directing them stock buybacks, dividends, or are they investing in sensible things that can continue to advance the business? Are they investing in their core? Are they investing in sort of fanciful peripheral things that are just wasting money? And then finally, what's their sustainable competitive advantage? Those are the five.
Those are the five about the business itself.
About the business itself. So, I mean, I think just listening to you cite those, I think we can all conjure up certain examples of instances in which it was really strategically done to expand into some other business lines. I'm thinking right now, for example, of both Amazon and Microsoft pushing out of their core businesses, Amazon selling things online, Microsoft doing software sales and moving into, for example, in Amazon's case, Amazon Web Services. Microsoft
See,
also has huge storage and computing services. So that's been fantastic
hold on.
as
I
an area
disagree
of
with you that that's a
revenue.
different business, though, specifically with
Oh,
Amazon.
okay,
Because
all
Amazon,
right.
to me, what Amazon did was they generated revenues. They built the back end of their retail sales business, right? And the
Mm-hmm,
whole web services just started because they had excess capacity. They had to build that for their business anyway. So they
mm-hmm,
started selling it, and then they realized, hey, this is a good business to be in, and expand it, right? If
mm-hmm.
it's totally different than if Amazon went from selling things online to all of a sudden, it's like this is actually a great example. The whole space travel thing, Blue Origin that Bezos funded, that's outside of Amazon,
Mm-hmm.
right? So that's a totally different business that founder is putting his money into and investing in, but it's not with Amazon. When with Amazon Web Services, to me, that's like a business that just spawned. It's same like Prime, their Prime like television network that they have right now. I think it's just called Amazon
Prime
Prime
Video.
TV, Prime Video. Thank
Mm-hmm,
you. They Netflix's back end was on Amazon Web Services. So Amazon was able to just flip a switch. They had all the infrastructure in place. All they had to do was start with getting these licensing agreements for content and push it out. So
mm-hmm.
I would say those aren't necessarily different businesses, as similar to Microsoft.
Well, I'm not faulting them. I'm simply observing that it was a
Yeah.
B2C idea, and then it became a B2B, and it's driven huge revenue. Though no question, as you've just indicated, that it's sharing the roots are the same. So, I guess what I would say is coming back to some of the other questions I had. So, looking at their business model, just kind of walk us through the an A and a B company in an industry where us, at least at a service level, it appears that they're doing the same thing. But upon closer inspection, you'd say, no, there's something distinctively different about their business models that makes them worth owning much more so than the other company. And I'm just going to volunteer an example here. So I could use ExxonMobil, Conoco, Shell, BP, Marathon Oil as an examples. So to me, it seems like they are drilling for, refining, distributing, and then selling petroleum products. And it doesn't seem to me, at least at my admittedly distant level, that at least in the nature of the business model, it's substantially different. Although I certainly recognize, given the scale, particularly of ExxonMobil, that it's a dominant presence in that category. So, can you give us an example that helps us understand how, at least on the first of those five questions, the business model examination proves to be in some instances meaningful in separating out the frogs from the tadpoles?
Well, so for me, the business model is not always a comparison of what company A does versus company B. It's as simple
Hmm.
as, do I understand what they're doing and do I believe in it? Right.
Okay.
So sometimes they're just so complicated where I just say I don't get it, and that'll be an opportunity to move on. I'll give you a
Hmm.
recent example. Last year, I was looking at some housing stocks, and they were uh, I was comparing what they do what their business models are, and you had one that was building it and then they would sell it, right? You had another that were taking sales orders before the build. You had another that was doing the same. They had a backlog. In addition to that, they were working on work. They had, I shouldn't say working on, they had a deal where they had said, um, if we don't have houses that'll sell, we're willing to rent them out. Well, as you've seen recently, the rental market is very strong. A big concern on the economy with the Fed raising rates is that housing prices are going to drop because payments are going up with higher interest rates. So when I was looking at those three companies, the one that was pre-selling and had a plan B set up where if things turn made me a lot more comfortable than the first one that was just building, having a model home and hoping and then trying to sell it. So not that one company based on valuation, Son, I think you can definitely look at all of the companies, right? But based on the current market environment, I liked company C in this case because I felt comfortable with one, their what I'll call their backup plan, and two, that could become another huge business, right? They could be the biggest landlord theoretically in the country out there if that proves to be a good space, even if it's a temporary space. Just with what the concern was on the U.S. economy, it keeps the company running, right? Company A, if you built a bunch of houses and no one's bought them, well, then you've just got to wait, right? Your money's tied up in those properties. Company B, if you built them with pre-sales, well, some of those pre-sales are going to fall off the books. At least with company C, I have that other opportunity, and they can keep building, right? They can keep building and renting them out through the market decline. So that's just an example of the business model. But great question. The very first place I'd start is, do I understand what they're doing?
So, and by the way, I just as a quick aside, you did mention a sixth consideration, which I failed to enumerate in that list, and that was the extent to which leadership of the company actually it has skin in the game by
Well, so
owning shares of
we
their company.
we have just started on my checklist. That those five things you mentioned were
Hmm.
just in the business. Next thing we
Hmm.
look at management and the owning some of the company. That was part of my screen.
Hmm.
And then I've got a couple more criteria. I've got um, seven categories that can lead me to deep dive. I think I mentioned on the previous episode, I built a checklist years ago that had almost 100 different items. And what I
Hmm.
found um, was that I still cover those same areas, but the questions are more broad, giving me
Hmm.
a little bit more uh, movement to adjust. Whereas when I had that list of almost 100 items, I was just checking boxes and not. I felt like not understanding the company and the business as I wanted to.
Okay. Well, I've got more questions on your list, but if you're thinking, Eric, you're killing me here. This is going to turn into a 5-hour, 5-part series, and you know how much I, Roshan, hate series. So don't. So stop your questions.
No, if
But
you've
otherwise,
got
I have
enough,
another question.
go ahead, and I'll try to be more brief with my answers, and then we'll go on to the
Don't.
next
No,
category.
no, no. I think I mean, I know that some of our listeners are going, "Oh my gosh, where's the channel? How do I change the channel?" But
Yeah,
some of them I know love this sort of stuff.
yeah.
So, but here's the question about the use of cash flows.
Mhm,
So obviously, if you thought they were directing cash flows towards some sort of Mickey Mouse, useless sideshow type of
mhm,
investment, you wouldn't like that. But assuming that they are putting money back into their own get business versus distributing money back to shareholders versus doing stock buybacks versus, and I'm going to tweak you here really hard, paying down long-term debt, which of those things, and listeners, the reason I'm doing that is because about a month ago, Roche and I had a raging argument on one of our episodes about dividend growth versus high dividend yield strategy. So we got into the question of paying down long-term debt. Uh, just ribbing you there a little bit,
yeah.
Roshan. But of those ways of deploying capital, do you have one where if by default you tend to favor that, or do you tend to favor some evidence of balance, or do you tend to favor some the rotation through those things depending on the surrounding economic conditions? How do you assess the one from the other?
So my ideal is their business is growing so much they have an unlimited supply of opportunities to reinvest or expand, so they can put it back in
Hmm.
the company. Just because
Hmm.
if they're Dividends are nice. I'm not opposed to dividend, but that's not exactly what I'm looking for when I get stocks that are high yielding dividend stocks or even paying a dividend at all. It's usually it just happens to be the case. That's not what I was looking for. I want the business to have opportunities to grow. So the other things you mentioned about paying down debt. Well, I'll go over that one last, but stock buybacks. If the stock's priced well and they're buying back, great. But once again, I'd rather them invest in their business. I recently heard a company say that their stock price got cut almost in half with the market decline last year, and they had said they think their stock is priced better than any acquisition opportunity, and that's the reason for their buyback. I like that as well. But just in general, if you're saying uh, talking about stock buybacks, it's uh, I don't want them to have a policy of a buyback, just to have a policy of a buyback. I want everything to be opportunistic. And then your final thing about paying down debt, I actually do like companies with low debt. Our debt example was where I was on the other side was dividend payments versus debt. But I also would want to understand the debt situation, right? I want all these things to be strategic and intelligent moves, not just done for the sake of doing it. So if you've got 30-year debt and you're paying 2%, and you've got an opportunity to expand your business that has a double digit plus return every year, if you're paying down debt in that scenario, I'm not a fan of it. On the flip side, if there are no real opportunities to expand because your cash flow is low, and your cash flow is low because you've got these huge amount of debt and high interest rates, then I'm all for paying down the debt. So I don't
Okay.
necessarily favor one versus the other. Just make the smart move for me, the investor.
Great. Well, thank you. So
Yeah.
you haven't, that was looking at the business. Now it's management.
Management. So I'm trying to understand what uh, I'm trying to understand how management works and thinks and find out what I can on them. This can also be challenging because some of it you've got to just interpret based on looking at their historical actions. But the first one and most basic question is, why do I like management? And it's phrased that way because if I don't like management, I don't want to invest in the company. Because once again, they are managing my money that I'm giving them to invest. Well, if I don't like them, if I don't trust them, if I don't like the decisions they're making, that's a pass, no matter how good the business is or how cheap the business is. Um, Next, do they think and act like owners? So, Eric, going back to your question of how they allocate capital, that very much is a part of that question. Are they making smart decisions like owners? Oftentimes, you'll get you'll see you'll definitely see management that acts like owners. You'll also see management that in some cases will be either ego driven or driven to protect their position or protect their job, right? And I don't want to be lined up with those types of management. I want management that is focused on growing the business. And then finally, do they understand what drives value within the business? And you can see that by where they're allocating capital. So going back to your question earlier, because capital allocation, I think, is such a big part of management decisions. If I see this company saying, we're paying down this low interest rate debt versus not investing in the company, I'm trying to research further as to why. Right? Why are they doing this? Because it doesn't necessarily makes sense. If using that same example or about investing earlier, we talked about where are they investing their money. If they're investing in these other businesses that are unrelated to anything they're doing, I remember, and this isn't about investing in a company. This is just how about 15, 20 years ago, Hollywood discovered that hedge funds would start investing in their movies, and most movies lose money, right? So if all of a sudden we see something, I wouldn't want to be in the hedge fund that's investing in Hollywood films. And if I'm seeing something, and assuming that I'm researching a company that's not in the entertainment space, and all of a sudden they're like, "Hey, we're going to make a movie," I'm not going to want to be a part of that. So where are they? That was just an extreme example that I remember from years ago. But are they putting their money into a space where they understand where they grow? Where they can grow the business, or is it something totally different? Like in that housing example, right? This company has no experience renting houses, but what did they do is they partnered with a management team that does, and this is a backup plan to keep the company growing in a harsh economic environment. I'm a fan of that. If they decided to get into something totally different, like we're going to start making movies, yes, that would be a red flag. Yep. Any other
Interesting. Okay.
questions on that section,
On the management section,
man, or anything so far?
liking them and thinking they're making good decisions.
Yeah, capable, and that's where their ownership comes into play, right? Especially,
Hmm.
I also love if they're buying right now, right? By right
Hmm.
now, I mean if I'm looking at the stock and I think it's cheap and they're buying,
Hmm. Hmm.
I like that as well.
So looking at insider purchases and sales, and which those data are available, do they publish? I imagine they publish those either in, maybe they're not talking about those in their quarterly calls, which you said you like the transcripts of quarterly calls as a starting point.
Yes,
But I imagine that they have those in either their 10Ks or something along that line,
they do.
or maybe
They've got
eight.
to file it with the SEC, and the site we mentioned last time, Guru Focus, it will literally list those transactions as well. So they're easy to find.
Okay. All right. All right. Yeah,
So,
and then do you have a preference for any other aspects of the management team, such as their ages, their pedigrees in terms of previous roles, or a mix of internal versus external, or anything of that nature?
I like so not specifically on that. Another thing I do like though in general is founders are nice. You're not always able to get them, but people who believe passionately in their business, which is why sometimes that stock purchase can be a sign of that. But you've
Hmm.
got situations where you've got founders involved or their family, and sometimes that's a red flag because that's nepotism, and other times it's someone trying to extend a family legacy. So you've
Hmm.
really got to just dig into that. So the management questions are very broad. I just don't know where that research and analysis is going to go. I also like people that have been around for a while. There's one of the companies I own where um, the CEO started as like a very low level staff member, has worked with the business for you know 30 plus years before becoming a CEO, bought shares and just been owns it as well. So you who's going to know that business better than that person who's been there for 30 years, worked his way up the ranks, owns and bought shares along the way.
You mentioned once before about the company size. I guess I'm not really thinking so much now about the management team, but I am thinking about the company. You said you try to cut things off at the $1 billion level. Below that, it doesn't seem like it's a fruitful place to go. When you look at the companies that you've picked up, do you have some sort of sense of what the median market capitalization is?
So, Eric, it's not that I don't like those smaller cap companies. I'm happy to look at them. It's just that from a liquidity perspective, it's easier to get in and out of the bigger companies without moving the price. Uh, but going back to the average market cap, I'd say I right now I'm tending to find more in the mid cap space, and I think that is generally the case, right? So
Mm.
what I'm looking for is the uh, beginning of that small cap space and up, but it tends
Mhm.
to be in the mid caps that I find it. But I'm not. Uh, that's not necessarily the intent. That's just what I found. Similar to dividends, I like them. I'm not looking for them though.
All right.
All right. Next, here's another broad one. It's what could go wrong, right? If the stock is trading at this price it's at this lower valuation level, and I believe it's a good business. Well, why is it cheap, right? Why is it at a good price? Why is it showing up? And what could happen with this company or this business that could be wrong? What's the other side? What's the bear case on this stock? And I can't give you an idea of how long or how much time that'll take. It'll just take me as long as I'm comfortable with that answer.
So yeah, I guess there's some things are exogenous, but some things you're seeing, which how you could not read that in a report, although you may have some sort of sense independently of what's going on in the market, what's going on in the economy. So can you give us an example of an instance where you put two and two together and said, yeah, I don't think this is trending well?
Well, so I'll give you a specific industry that a lot of names have come up for that I've analyzed and is on my list to go back to some specific companies in this space. But in the RV and the boating industries, stocks are just really cheap. And there's a couple in there that have the management team that seem to fit the criteria that I'm looking for in a management team, and the business that I felt comfortable with understanding. But I passed on it just because just because I don't know that I'm a believer in the expansion of that space to the rate that that those companies are, right. And the reason I'm gonna so I passed on it in terms of the just going through my list. The business, I felt comfortable understanding the business. The one question I don't know if I believe in that business list is it a growing market, right? And that could just be I need to do more homework. And then, but I got to the point of management, and I like management. I got to what could go wrong, and I thought, well, what if all this expansion that's happened in that space is purely people looking for things to do during COVID times, and now things are getting back to normal, and that's the point where I ended up passing on it. The reason it's on my list to revisit is I just happened to catch an article about management in one of these companies, and I like what I read, and they've done a great job. If I remember correctly, they started the business in the late '80s. They've done a great job with the business, and so I'm thinking, okay, they know the business better than I do. I want to go and spend more time on it. And if I'm not a believer
Mm-hmm.
in the business and the space, I'll just pass again, and that's enough for me. But when I researched it previously, that my what could go wrong is the growth just COVID related and not real and sustainable. And I'm willing to be wrong on both sides, but the stock is still cheap. It's worth potentially spending more time on for me. So that the what could
Well,
go
so
wrong could
that
be really anything.
Well, so that was that example is, I think, a really interesting one and a very interesting case study. It was obviously the case that when everybody was told, stay home and don't go to work,
Hmm.
that what happened was don't go to restaurants, don't go to stores, don't do this, don't do that. Suddenly, RVs went kaboom,
Yes.
and so did boats. They
Yeah.
just, those two industries just blew up. And it also coincided with extremely low borrowing rates, so people could finance a purchase like that if they didn't have one already. I mean, national parks, it's just been unbelievable trying to get a reservation for a campsite in a national park. I'm aware of that, less familiar with the boating world. But now that rates are up and people are free to go do other things, I guess I would be thinking, that's an industry that managed to sell a lot of its the boats and RVs that it would have sold in the mid 2020s and maybe in the late 2020s. It got those all out of the way. It all, it rung the cash register in 2020 and 2021, and now maybe is teed up for something that's a counter reaction of a slump. You may hear that and say, that's crazy. You're not looking at the numbers. And you're absolutely right. I'm not looking at the numbers. So is it possible that it's cheap for a reason?
That's exactly why I passed on it. What you just described is why I had said, okay, I don't know that I want to invest in this at all. And I don't. If I had to make a decision today, I'd say I don't want to, this is
Mm-hmm.
one of those that's worth moving on. It's just what's changed from the last time I decided to move on, which was about 3 months ago. Is I read some interesting stuff about management, and I thought, okay, maybe it's worth looking into it further.
Okay.
And
So now,
I'm by no means saying that I'm going to invest in that or not. It's just that it may be worth spending a little bit more time on, um, than I than I had before. And it could literally be a 10 minute, probably not 10 minutes. It could be an hour long exercise where I decide, okay,
So
I'm
this,
comfortable with what I did.
all right. So this question maybe is a little bit off, and you can say, Eric, let's save that for later, or that's not germane. But since you're looking to buy companies for the long haul, you think that have long term sustainable competitive advantages, do you then look to do you find the roots or the sort of the genesis of those extended success stories starting in something that seems like it's more, I don't want to say faddish because I don't mean to be dismissive of this, but I'm thinking of something like right now pickleball is exploding.
Yeah.
And so obviously it doesn't cost as much to buy a pickleball racket as it costs to buy a boat or an RV, but nevertheless you have a massive sort of uptick in this particular sport. So is that an example of something where you'd say, okay, manufacturers of that, or at least the people that construct these courts, or is there any, obviously I know so little about it. Is there
Yeah.
some sort of business in there that registers as something that's promising, or do you look at that and go, no, it's too small potatoes, or it's too faddish, or how do you think about that?
So I with the pickleball example, I'd want to start with the company. Are they growing and do they meet the valuation numbers I'm looking for? I'll give you a different example that I think sort of lines up with what you're looking at is the AI space. I think there's a
Mm-hmm.
huge opportunity in the artificial intelligence space, but those companies aren't making money right now. They
Mm-hmm.
they tend to be in the burning money phase versus the making money phase. So they don't show up as something I'll look into because I want something that's growing revenue but growing profitably. And all of those companies are losing money. So those numbers I gave you earlier of return on capital and return on equity, they're going to show up as negatives. So I won't even end up
Okay.
spending time on it.
All right.
So I compare that to pickleball because if there is, I don't know who the leader in that space is, but
Mm-hmm.
said differently, let's just say hypothetically, there's another tennis Wilson that makes tennis rackets and basketballs and so
Right.
on is now expanding, and they're the dominant player in pickleball. That might be an opportunity, but I have I know it's the fastest growing sport, but I have no idea who the players are in that space in terms of the
Mm-hmm.
equipment
Okay.
providers.
All right. Well, good.
So
So
we
you've
went
talked about
over.
companies and management. What's next?
Yeah, we talked about the business management, what could go wrong. Next is price and valuation, right? And it, here's an interesting one because what I've learned over time is that each company deserves its own valuation metric. And I don't mean you've got to reinvent the wheel. I just mean there's so many ways you can value businesses and companies that you've got to figure out which one you believe applies in this case. So typically, when it's a company that I'm looking at cash flows and or earnings, and looking at trying to create some sort of present value based on that, including the numbers I've generated with growth and expansion. So like with their growth and their return on capital, I'm looking at long-term averages and do I expect them to continue versus just what happened last year or the year before. And uh, then the future value of the business. Like there's one company we looked at that's an auto dealer, and they're expanding, buying more dealerships. So I broke down, looking back the last 20 plus years at their profitability per dealership, and then what should that lead its value to be? So because they're continuing to expand and grow and have more dealerships, so to me that made the most sense versus using, because if I'm using a 10 or 20 year average of their cash flows, well, 10 years ago they had a third of the dealerships they have right now. So that 10 years ago number is really not that relevant today. So that's where, so what I have written down here is what are they worth and why? What metric am I using and why? And then what is my target price? So I've got to answer all of those questions. That part is not as complicated as the first two, which is why it's intentionally later on. In general,
Mm.
with the screens I'm using, I'm going to find stocks that appear to be undervalued. So that valuation metric should probably line up anyway, but I still want some kind of price. The other thing is there's so many assumptions involved that valuation is not a science by any means, right? It's more art than science. So I think it's I want to buy something that's selling at a good price, but it is intentionally fourth on the list because I believe if they're meeting the other, if I found them through my screen or any of the other sources I use to normally reading and research, the first thing I'll look at are some of these numbers if I just heard of a stock that I hadn't before, and that'll tell me whether it's worth looking into. But it's really got to pass those other hurdles, and I believe that I'm already fishing in a place where the stock's probably selling at a good price. But it's very possible I get through those first two steps, spend a bunch of time on it, come to valuation, and it's not selling at a good price, and my time was for now wasted. But similar to that RV company I mentioned, the research I've done already, I've already done. So if I go back and look at it again in the future, it's I don't have to spend the days and hours I did previously. It'll just take me a very short amount of time to catch up on what I did before and then continue my research.
So now when you're talking about valuations, obviously that's an area that I understand better, and because it is just a quantitative assessment. But let me ask you then another question about valuations. So as you are well aware, certain industries trade at different multiples, valuation multiples, historically, than other industries do. Some industries sustain, higher valuations or higher multiples, and manage to preserve those on a sustained basis, and the opposite for other industries. It's also the case that can be observed at the company level, that certain companies themselves have persistently higher multiples on those valuation ratios, whereas some others have persistently lower ones. So we call the first of those types, where you're comparing to other companies or other industries, we call that cross-sectional comparisons. The latter, where you compare a current valuation of a company or an industry to its own history of valuations, that is known as a longitudinal comparison. So in your case, do you employ one or the other strictly, or do you use both? How do you approach those kinds of valuation assessments?
I will look at that after the fact. So what I'm looking at first is, what do I think this business is worth? That's it. What do I think this business is worth? After that, I'll look at what is it worth historically, what is it worth compared to the industry.
Mm-hmm.
So it's got to first pass my test of being cheap enough. And
Well, the reason I ask that is, go ahead.
Well, I was just going to say that the one of the considered one of the most valuable contributions of Benjamin Graham was the margin of safety, meaning you're buying a company so cheap that if you're wrong on something with your analysis, you should still have a very minimal downside risk. So I need the company to be at ideal. The ideal scenario here is buying a 50-cent dollar. I think it's worth $1. It's trading at 50 cents. And now, once you start looking at their future prospects and their growth, it's not easy to find, but they're also not as rare as finding like another thing Benjamin Graham was famous for were these net companies, right? Trading for a net of their value. But we talk about different valuation metrics. In that net comparison case, you're looking at companies that really could go out of business, right? But I don't want that, so I'm not looking for the net. What I'm looking for are companies that I think will continue to grow and expand. So that's where picking the right one based on the business type is important.
Well, the reason I asked that, Roshan, is it's something that I would say is a challenge for me in some of the models that I do, and I don't want to turn this to talk about. I want to not about those models that I use, but instead just the principle here. I may find a business that I think, dang, this business is trading at 50 cents when it should be $1. I'm buying $1 basically for 50 cents. That's a bargain. Come to find out later, well, wait a second. That company pretty much always trades at 25 cents when it should be $1. And
Yeah.
I just overpaid for it relative to itself, at least at 50 cents. So the longitudinal comparisons are ones that they're harder to do than the cross-sectional ones. And so I just wondered if, because you are taking that deeper look, if that factors into your thinking.
I definitely do. I definitely look at historical PE pricing that the company will have. What does
Mm-hmm.
it typically trade at from a PE perspective? But
Mm-hmm.
that um, I'd read once that there are two ways you can make money. Right, the company's going to expand and PE expansion. So if they're
Mm-hmm.
trading at a low PE compared to where they were relatively, I like that. That makes me feel better about the PE expansion side of things.
Mm-hmm.
However, if I, at that point, it really is a judgment call with what I believe, right? If I think it's
Mm-hmm.
cheap enough and growing enough, and it's trading at its current PE, so let's say it's trading at a PE of 7, and it always trades at a PE of 7. Well, if this company's growing at 10-15% a year, what a PE of 7 means will be higher next year than it is this year, right? So then I've got to
Mm-hmm.
look at the growth there. So that might, in that scenario, what you described, it might tell me, well, PE expansion is not going to help um, drive this, but I believe they're going to still grow at this. They've had a history of growing at a higher rate than the markets typically do, and I believe that'll continue. That in that scenario, I'll be fine with it. But if I don't think
Mm-hmm.
that industry is going to grow, which means that PE multiple expansion is not going to happen anyway, well, I usually don't
Mm-hmm.
make it to this step. So I'd like to think that a lot of the question you just asked is solved by number one and two, or one, two, and three. However, in step four, where I'm looking at the valuation of the business, if I don't feel comfortable there, in each of these scenarios, anytime you feel like it's not meeting what you're looking for, you just got to be ready to move on. And as I said, the valuation normally looks good just because of the screens anyway.
Mm-hmm.
So I've got to feel comfortable that I think that the company is going to, if the business grows, the stock price will follow.
All right. So we've dealt with the business, we've dealt with the management team, we've dealt with what can go wrong, we've dealt with valuations. Are there other categories that are part of your deep dive?
Yeah. Well, next is, am I comfortable holding this for a minimum of 2 years, and why? And
Mm,
underneath that, the subcategory is, if the stock dropped, assuming nothing else has changed fundamentally with the company, would I feel comfortable holding it or buying more? And that's got to be a yes for both of those.
mhm.
If it's not, it's time to move on again.
That sounds more like then an independent. And then I'm not, by the way, I am not in any way faulting this means of decision making, because I think that is actually a big difference between your approach and my approach is I just don't trust my judgment about some of those things. So I make it all, rules based, all quantitative.
Hmm.
But given how much time then you've spent in the call transcripts and in the annual reports and all the other documents, what it sounds like you're saying there is that I have to have some sort of global, maybe if I'm thinking about this right, right brain sort of sense that this whether I can pinpoint what it is, I have to have some sort of global sense now that, or now maybe intuition is the wrong word, but just some sort of sense about the company that I feel comfortable I could hang on to this. Is that what you're saying? Is it just this kind of global synthesis of all the inputs and all the data without necessarily being able to point to one single thing?
Well, I would have reasons why I had that conviction, right? So
Mm-hmm.
I'm not pointing at one single thing necessarily, but like with that um, home builder I mentioned, for example, am I comfortable holding it for 2 years? Yes, I'm comfortable holding it for 2 years. The valuation's good. They're paying a little bit of a dividend. I believe in management. They've historically had a return on equity of over 12%. When management came in they had 3% return on equity, and one of their primary goals was they were the lowest in the industry, was to be the highest in the industry, and they accomplished that. So all these things, it's really a compounding of little things that make you have the conviction that if the stock price just drops because of, and once again, nothing significant happened within the company. If the stock price just drops because of the market and the economy, am I willing to hold? That's a yes. Right. And on that valuation earlier, I think it's a 50-cent dollar. So I'm willing to hold and even potentially, once again, assuming nothing major's changed, buy more versus wanting to sell. I don't want to buy
Okay.
anything I won't hold for at least 2 years. Typically, from my research, if you're buying these 50-cent dollars, it takes 18 to 36 months to reach fair value. And if you're buying a true compounder, a company that's continuing to grow, well, the valuation's now worth more 18 to 36 months down the road. So if I'm not willing to stay the course, then I shouldn't buy it at all.
Okay. So business, management team, what could go wrong? Valuations, and now would I be comfortable holding it for 2 years?
And
Is
why?
is there another, and why? Is
Yeah,
there another consideration?
yeah. So this is different from what could go wrong, but this is why am I right and why is the market wrong? Right?
Mm,
So what could go wrong means to me means what could go wrong with the business. Well, what could go wrong with the future growth? Here it's why do I think the current price is wrong? So I hope you can understand the difference. One is business driven, one is price driven, and this could be anything. What I think a lot of what I believe right now is I think the market's thinking very short term, and I think if you think long term, that gives you an opportunity. And it can literally be as simple as that. Why did the stock price go down? Well, because of what's going on with just as an example, going back to that housing, why is the stock going down? Well, Fed raising rates, causing mortgage rates to go up, potentially less home sales. The counter to that is we have an undersupply going back now 14 years, and the
mhm,
companies continue to expand. They have a multi-year backlog of homes to build that are pre-sold, and then they've got a backup plan of these rentals. So why do I, in that example,
mhm,
why do I think I'm right and the market is wrong? I think the market's being short-sighted in this case with what's going on with the overall macro economy. I think they're overstating what's going to impact the company itself, and I think the company is prepared for that. And I didn't mention this on the analysis uh, at all when we went through this, but I'm going through their annual reports, their balance sheets, and so on. So in the housing company, their balance sheet is strong, where they can withstand a decline. The stock, it might slow how long it takes the stock price to recover, but they can withstand the recession. They can withstand the slowing in home prices. And if this rental model works out, not only will they withstand it, they'll do it profitably, highly profitably, right? So that's just an example of what when I'm looking at what could go wrong, I'm looking at anything that could go wrong that could cause the business to suffer. When I'm looking at why am I right and the market's wrong, that's specific to why do I believe it's mispriced. And what you
mhm.
talked about earlier with some companies just having a lower valuation, if my answer is just, well, valuation's low, but it sort of always tends to be low, that's another reason to pass.
Okay.
I've got
Is there another category?
one other
Yeah.
question is what percentage will I buy and why? Am I going to buy the minimum or the maximum? If I don't want to buy the maximum, I want to know the rationale behind it. If I found this great deal that's met all of my screens, why am I not willing to do a maximum position on it? So that's the next step. And if I ever want to expand what I'm buying in there, I've got to revisit this checklist, look at all these things. So if the stock price goes down and I want to buy more, I've got to revisit this checklist and then answer that question again. Why am I buying more when I only wanted to buy X before? And
Hmm.
in most recently with what's going on in the market, it's literally been as simple as I'm concerned about the markets pulling back further and maybe I can get it at a better price. If it's that simple, then
Hmm.
it's a buy. Other scenarios could be things like, well, I own multiple other companies in this space and I don't want to get too much in this industry or sector. So that would be a scenario where the stock price dropped, and unless I'm willing to sell something else, I'm not adding to the position.
Hmm.
There's one
So
last category, which is just
yeah.
general notes, and that can lead to anywhere. It can be a question that I had earlier, like for example, in recent history, there was a company I was looking at, and the question of where they're investing their cash flow, it's to it's for acquisitions. Well, then my automatic first question is, are they acquiring these companies at a good price? So I'll put that in my notes and make sure I answer that before I do anything. I might just find that through my regular research. But if I don't, I've got that category to make sure I go back and revisit those items.
Mm. So then, two other questions. One is, do you find that this process leads you to, on balance, rarely make purchases in certain industries, certain sectors that you've just noted? Yeah, I never seem to find anything there that checks all the boxes. And conversely, are there some industries where you find, wow, I really apparently have a love affair with this category? At least they are the companies that match the sorts of long term holds that I'm looking for.
Uh, Not at all times. The
Mm-hmm.
market tends to dislike certain industries at the same time, so we'll tend to find a lot of names. So I mentioned on our previous episode, there on the list there are a lot of housing, a lot of RV, a lot of boating companies that
Mm-hmm.
are showing up on the screens right now. And so it's not that the research does compound, so it's easier to understand the business model of housing company B as I've studied housing company A, but it's just
Mm-hmm.
what's going on in the economy that leads to it. Like there was a healthcare name that came up that I've not researched yet, but that's on my list where I'll deep dive on them next. I was just excited to see a healthcare, a different industry, different space name, and I want to learn more about it. So it's the ideas that come up lead to it, and the economy and the markets tend to lead those into specific areas. 08, 09, you're
Okay.
seeing a
Then.
bunch of banks, right?
Mm-hmm. Mm-hmm. So I have one last question that occurs to me here is at some point we all find, oh, I was wrong.
Yep.
And so, what does it take for you to say, "Oh, that was everything seemed like it was all lined up. Now the thesis, I have to revise it." What does it take to get you to say, even if it hasn't reached your 2 year mark, to say, "Sorry, time to cut ties. Let's move on."
There has to be something fundamentally wrong, right? The growth and expansion plan that I thought they were doing, and when I say I thought, it's going to be because that's what they said, right? I'm seeing this in their annual
Mm-hmm,
report. So, well, they're
mm-hmm,
saying they're doing this, but they're actually spending their money in a different space, right?
mm-hmm,
Or if there's a specific business line or product that they have, and we're just demand goes is dying for that product. Like I haven't made any change because of this, but just I just read an article about the semiconductor space, and that we had such a shortage, and now they're thinking there's a potential glut in that space, right?
mm-hmm,
That's something that could get me to change my view on a semiconductor business. Now, this was a general article. I do own semiconductor stocks, but I've got to go back to my analysis now. And if at my conclusion of that analysis, I'd say, okay, well, it was based on this kind of growth, this kind of expansion, and that's not what's going to happen. That would be a scenario where it would be a change. I don't really see this often, but another thing I couldn't tell you the last time I saw it, but another thing could be some kind of management change. Now, I'd love a business where the management doesn't matter, but if I've put my trust in uh, management team A, and there's a change, I'm going to revisit it. And then if
mm-hmm,
management team B is going down a direction I don't like, that would be another reason. I mean, each of these have reasons to change your mind. The first one on the business was what I mentioned earlier with semiconductors management. With what could go wrong, maybe whatever I thought could go wrong starts to happen, right? And that would be another
mm-hmm,
reason. Price and valuation. Well, if you start seeing a slow in growth, you would see an adjustment to your valuation target. And if it's not a good deal, it's just not a good deal anymore. And the question of why am I right and the market's wrong could be wrong, right? Right? I
mm-hmm,
could be wrong, and the
mm-hmm.
market could have been right
Right.
the whole time. And there's
Mm-hmm.
another factor, just all the housing commentary I made earlier. Well, in that the government could keep raising rates faster, housing could slow faster than I thought, and their potential rental business could prove unfruitful. If all those were to happen, then that would be another reason
Mm-hmm.
to get out as well. So there's no specific answer, but if anything affected those major, 7 categories, or really 6 categories, the seventh just being what amount you're buying. But if anything could significantly impact those 6 major categories, that would be a reason to revisit the decision and potentially go the other way.
So to this point, you've talked about really individuals, the considerations that go into the assessment of which individual company whose stock you'd like to own. What we haven't really talked about so much is maybe a little bit. I asked you the question about um, concentration in certain sectors and what have you. But thinking about it at a larger portfolio level, do you have any other sorts of constraints that will sometimes cause you to override a decision because you say, you know what, I'm way too concentrated in this, or something of that nature? And if that doesn't apply, do you then sometimes look at the portfolio and you go, man, I really want to own this next one, but which of the other things do I sell or shave down to create some sale proceeds so that I now have the wherewithal, the capital to now deploy into this new company? How do you handle those portfolio level decisions?
Okay, so I try to make sure I've got I try to make sure that and I won't have, I normally don't go this high, but I do sometimes. I won't have more than 12.5% in any single stock. And if it's an
Hmm.
industry type decision, I try to make sure that that industry is capped at that similar level. Most of the
Okay.
positions aren't that high. At the same time,
Hmm.
I try to make sure there isn't less than 3% in a company. So I'm normally
Hmm.
looking at, and I know if you multiply 12 and a half, 100 divided by 12 and a half, you're not going to get this number, but it just tells you how rarely that 12 and a half happens. That would be 8 companies, but I never
Hmm.
want less than 10, and I don't want more than 30. So I'd be happy with
Okay.
30 different companies if I can
Hmm.
find them. Uh,
Hmm.
but I don't want 10. Now your question of, if I find a company I really like, well, it's got to be better than what I've got, right? So that's when
Hmm.
I'll look at all of the individual companies. So if it's fully invested, got to look at all the individual companies and say, okay, well, what do I want to sell to make room for this, and why?
Hmm.
And there could be a variety of answers there. That one other company could just be, I think, a better opportunity, or the other one could have gone up in value, and I want to take some profits on it. There could be a
Hmm.
lot that goes into that one.
So in terms of turnover at the portfolio level, how much would you say you're trying to hold these things for the long term, so it's got to be painful. It's
Yes.
something you've invested so much time and effort in, and such, to shave it down, or let alone to part with it. So how much that probably leads to fairly low turnover level in your portfolio.
It does. I actually don't have the data behind that, but I can't
Okay.
imagine turnover being. I can't imagine. I think turnover is going to be in the single digits neighborhood,
Oh,
on there.
wow.
So it's
Hmm.
going to be relatively low.
Hmm. Hmm. Interesting. Well, today's a trading day for me on one of the strategies, and I was just looking at it beforehand, and there's going to be a lot of turnover today. So it's cool to hear your approach where that's not the case.
Yeah, and once again, if you're investing in the business,
Hmm.
businesses take decades to change, let alone years. When the turnover ratio typically is looking at 1 year change, right? So if you
Hmm.
found something that you like for the long term, and once again, nothing's changed um, in the long term thesis of it, you hold.
Hmm.
But we talk about multiple strategies. I've got another individual stock strategy, Eric, that I use, where um, there's typically 20% turnover uh, a year, which means they're keeping 80% of the names, which in the investment in mutual fund world is considered, considered low, 20% or below.
Mm-hmm. 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 Yeah. Well, we're at the longer end of our normal episode length, but this is a fascinating discussion. I want to make sure that there's nothing that you felt was really important for our listeners to understand about this approach. It's not, the just pure quantitative approach that I use. It's really digging in and getting to know these companies. Is there any other thing that you think our listeners would profit from learning about this method or this approach?
And I'll just mention that, similar to what we talked about last week, this is something where I've been able to take from my research analysis things that have worked successfully for investors in the past. So I'm just
Mm-hmm.
trying to look at what's worked and continue with it. So nothing is really mine aside from how I chose to pull it together in a way that's
Mm-hmm.
comfortable for me. It is really
Mm-hmm.
from a lot of successful investors, and so I'm looking at when I look at this, it looks like I'm just picking something that's worked, right? It doesn't look like
Mm-hmm.
it's that I know as we go through the data, there's a lot of information out there, but I think
Mm-hmm.
it's more simple than it sounds when you start getting through the process.
Mm-hmm. Great. Adrian, do you have any final questions before we adjourn?
Well, we touched on last episode, it's really just stacking the deck in your favor. We know as investors, there are limitations when it comes to just learning everything you can about a business or investing, but all these categories and different investing approaches that we brought up today were just ways that you can really help come to a sound decision on whether investment's right or wrong for you. So I really like that point that we've been hammering on, just to really put the odds in your favor.
Mm-hmm. Yeah, to our listeners, we thank you so much, first of all, for sticking with us this long. And we just want to emphasize, if you're newer to our show, this is not necessarily the depth and that, at least on this one investment topic that we usually pursue. Encourage you to go to our website, retirementlifestyleshow.com. Go up to the top of the page. There's an all episodes tab, and you can then open up everything in reverse chronological order. Use the search box to find topics that are of interest to you. You'll find we deal with a lot of other things, but we don't deny that there is an analytical tilt to our thinking, and so it is for us a lot of fun to both do what we do and also to talk about what we do. That technical or analytical capacity and disposition, though, I think at this point also bleeds into the other aspects of what we do, which is in planning and helping you succeed on the goals that you're pursuing. So we invite you to, if you haven't done so already, explore more of those episodes. If you haven't commented on our show, please do. We love to get feedback. If you haven't rated our show, please do that. It also helps other listeners discover the show. And so for next week, I will be out at a conference. We're not going to try, as we've done in weeks past, to have me to try to get in only to find it's a failure. So, gentlemen, I hope you have a ton of fun next week with next week's episode. In fact, I think I know the topic. Have you decided on it?
We have not yet. So if you know it, you're ahead of us.
I thought we'd had a little bit of a chat about that. So, okay. But in any case, listeners, thanks so much for listening. And we'll be back again next week with another episode of the Retirement Lifestyle Show.